I want to welcome you for this lesson, for the lesson today. I want us to start immediately so that we can finish this topic tomorrow. We need to finish the topic tomorrow, and with that, we'll have done justice to ourselves. If you can see my screen, let me know. If you can see my screen, let me know so that I can start off. Can you see the screen? Let me hear your response. Let me see your response. Whether you can see my screen before I start. I'm waiting for the feedback. I cannot see the response. Can you see the screen? Oh yeah, yes, we can. Someone has written that. Yes. That is an indication that my screen is visible. Last time we introduced what we call the Mira and Modigliani. I have decided to get into something to expound it better because I have noted we need to understand this thing of Mira and Modigliani very well. What I'm displaying, I've given it a heading, Theories of Capital Structure, so that I introduce you to Mira and Modigliani in a better way. So it is from where we stopped last time, and that is from where we are continuing. I want to give briefly what is theory of capital structure so that I can introduce you gradually to Mira to the MM preposition. We say that from what I'm displaying, the theory of capital structure are concerned with the following three items. Theories of capital structure try to understand, to help us understand if the amount of debt, if the debt in the capital structure affects the value of the firm. Does debt, if you have debt, is there any implication on the value of the firm? Two, whether the amount of debt capital in the company capital structure affect the cost of capital. That is the other thing. Does it affect the cost of capital? Then number three, the argument number three is if the amount of debt in the capital structure affects the cost of capital and the value of the firm, if the value of the debt affects item number one and item number two, can we then have an optimal capital structure? That is the question. These are the things that we need to respond for any time that you are dealing with those theories. And even the Mira and Modigliani was trying to answer these three questions. Does debt affect the value of the firm? Does debt affect the cost of capital? If the debt does affect the cost of capital and the value of the firm, then can we come up with an optimal capital structure? It is the question that is answered by the theories of capital structure. And these theories are three. There is one we call the net income approach. There is the other one we call the net operating income approach. And then there is what we call the traditional view. When we are using this theory, there are assumptions that must hold true to all the theories, but each theory has its own assumption. When we are talking of the theory of the capital structure, when we'll be dealing with the MM and the other theories, there are assumptions that we must hold. And that simply tells you, if you are told to give the assumptions under the theories of capital structure, this is what you give. Number one, the capital structure of a firm has only two sources of finance. Simply, we ignore the preference shares. Remember, long-term source of finance is equity, preference shares, and debt. Under these theories, we don't talk of preference shares. We only deal with the equity and debt. Because sometimes you'd have someone ask, what if there is preference shares? Preference shares are assumed to be non-existent. Assumption number two is that all companies have a similar dividend policy of 100% payout ratio, meaning earnings per share is equal to the dividend per share. And as a result of that, there is no retained earnings. All dividends are paid 100%. The other assumption is that capital markets are assumed to be perfect. There is information processing efficiency. There is transaction efficiency, that the cost is inefficient. The price of the market is determined perfectly. Assumption number 4 is that the return on capital employed will remain constant and the company will retain its original capital structure. What does this mean? It means if your profitability is a certain amount, you are expected to remain earning that amount as long as you do not change the capital structure. Those are the assumptions, and again, they form the weaknesses of these theories, because how many firms pay dividend 100%? How many markets are perfectly perfect? How many firms will invest and earn the same earnings throughout their life? So it forms the limitation. I want to explain the basic one, which we call the traditional view, and I will explain it from this perspective. I will use a diagram, but that diagram will explain these points. According to the traditional view, the capital structure is relevant. When we say that capital structure is relevant, it means debt affects the capital structure. The theory states that, number 1, cost of debt will always be lower than the cost of equity. The increase, as you increase debt in the capital structure, the cost of equity will increase insignificantly. So we say that the increased use of debt capital has no effect on the cost of debt. The cost of debt is constant up to a given relevant range, where when you put a lot of debt, the cost of debt will start to increase. Now, the other one is the cost of equity will increase insignificantly. As you increase debt within a short period, then it will start increasing significantly. We say that beyond the relevant range, cost of debt is constant. The cost of equity is increasing insignificantly, but beyond the relevant range, there is an increase in debt and cost of equity. As a result of that, WACC decreases, then it starts increasing beyond the relevant range. And this is what I have on this diagram. Look at this diagram. We are saying that if this is cost of equity, at a certain point, it will start increasing. The weighted average cost of capital is decreasing, then it will start increasing. Then we have the cost of debt is constant, then it will start increasing. That is the argument under this theory. Let me put this WACC there, so that at least, so that at least we can have it well. And we know that WACC is cost of equity, weight of equity, plus cost of debt, weight of debt, like that. That tells you that in this theory, there is optimal capital structure. Let me remove this cost here. I can place it here so that it can look a little better. Let me show you where I place it. Let me have it there as the cost of debt, like that. Then it tells you that when the WACC decreases, it will get a point start to increase. Don't increase the capital beyond this point. It is the optimal capital structure. That is what we call the traditional view, the traditional theory of capital structure, without a lot of technicalities, as we will see in the other theories. I don't know whether someone has a question. I would want someone I want to check whether someone has a question. or anything. Okay, I cannot see anything. So that is what we call the traditional view or the traditional theory of capital structure. It is explained diagrammatically as I have reflected. So we say that the increased use of debt within the relevant range will lead to increase in the value of the firm. Beyond the relevant range, the WACC started to increase, and therefore the value of the firm will decrease with the increase in WACC. We say that there exists an optimal capital structure. Let me explain the net income approach. Now, the net income approach try to argue out the same argument as the cost, the traditional view, but it gives an argument that the cost of the cost of debt and the cost of equity will remain constant throughout. And as a result, the more you borrow, the better for the firm, because WACC will go down. At the same time, the value of the firm increases. And this is what we have here. The fundamental assumption of this theory is that the financial risk or gearing does not affect individual cost of capital, meaning that when you borrow, cost of equity is not affected and the cost of debt is not affected. That is why we are saying the cost of equity and the cost of debt will remain constant at all levels of debt. It also agree that the cost of debt is lower than the cost of equity. The cost of equity will be higher than the cost of debt. Why? When there is tax, there is interest shield, tax interest shield that benefit the providers of equity. The other thing is the providers of equity are subjected to a higher debt. They are therefore compensated. They are therefore paid more because of the risk they have undertaken. Then if you look at what I'm saying here, although the financial risk has no effect on the individual cost of capital, it will affect favorably the WACC, meaning as you increase debt in the capital structure, the weighted average cost of capital will continue decreasing. This is the favorable effect of debt according to this theory, the net income theory. And I want us to look at it. I want to demonstrate it using an illustration so that we can understand the computational part of it. If you can see the screen, I want to read the illustration to explain the net income theory. The question reads, an investor is evaluating 3 firms, A, B, and C, whose capital structure are as follows. Firm A, B, C, we are told that A has 100 million equity, B has 80, and C has 60. The debt finance, A does not have debt. It is 100% equity. B has 20 and C has 40. The 3 firms are of the same size as measured by the capital invested. Then we are told that the required rate of return for the 3 firms is 10% and the cost of capital is 10%. The required rate of return is 10% and the cost of equity is 10%. So the question is, determine the value of each firm and explain the difference in the value of the firm. Remember, we've said if the firm is fully financed with equity, it has a value, but when you introduce debt, the value increases. So from what we have, we are likely to have a value in A, B will have a bigger value than A, and C will have even a bigger value compared to B than A. That is what the theory tried to explain. When you have debt in the debt capital, in the capital structure, you are likely to have more value or a higher value in the higher value of the farm. So determine the value of the farm. Then number 2, explain the difference in value. Why are the farms different? That is what we need to understand. 30 seconds, look at that illustration. We work on it together. Good. I believe you looked at it, and we can now try to work on it. We see what it means in determining the value of the farm. First things first, the value of the farm is from the perspective of equity and from the perspective of the debt. But what we are told is, look at this point. At this point below, we are told that the required rate of return for each of these farms is 10%, meaning the invested capital will give earnings before interest and tax of 10%. We take 10% multiplied by 100 million. That is how we are getting the returns. So it should be 10% multiplied by capital employed. 10% multiplied by the capital employed. For each of the 3 farms, it is 10. Let me have it like that. Or I can have it, oh, sorry. Yeah, I can have it here like that. So the earnings before interest and tax is 10% of the capital employed. We need to charge interest minus interest. The first farm does not have debt. The second farm has 20. How much is 7.5% multiplied by 20? How much is 7.5% multiplied by 40? For A, the interest is 7.5 times 20 is 1,500. For B, 7.5% times 40 is 3,000. That will help us to get the earnings before tax. We take earnings before interest and tax minus interest, we get the earnings before tax. Then we talk of less tax. In this question, we are not given tax. And always, if in the exam you are not given the tax rate, your work is to answer the question. Don't set the exam. The examiner will have the reason why he decided not to give. In this one, we are not given, and therefore, whatever is left, as we said in assumption number 1, that all earnings are paid out as dividend. This is the earnings to the ordinary shareholders, and it is what will be paid as dividend. Having determined what the providers of debt will take home this. For each farm, providers of debt in A, they take 0. Providers of debt in B, they take 1,500. And providers of debt in C, they take 3,000. Then we have what is left to the ordinary shareholders. How they perceive the farm gives them the value of the farm. And the value is based on cost of equity, that is earnings to ordinary shareholders divided by cost of equity to get the present value. Earnings to the debt providers, which is interest, divided by the cost of debt. When you add the two, you get the value of the farm from the perspective of the debt providers and the equity providers. This is what we have, that if the equity holders, these ones, will take home farm A 10, farm B 8,500, farm C 7,000. If we divided this by the cost of equity, remember we say that cost of equity is constant at all levels of gearing. And therefore, under this theory, the cost of equity is 10% for each of the firms. So the first one, we are taking this 10, and it is the one here, 10 million, divided by 0.1, it will give you 100. For firm B, because the provider of equity got 8.5 million, divide by 10%, 85,000 or 85 million. The third one, providers of equity got 7, divide by 0.1, they will take 70 million. The providers of equity sees this value in the firm. The providers of debt will see the amount of debt they have given. That is their value, this one. If you look at the question, this one, they have 0, this one has 20, this one has 40. We can again determine it by taking interest divided by the cost of debt. The cost of debt is 7.5%. So for the first one, we are taking, they get 1.5 million, divide by 0.75, this is 20. The second one, they take home 3 million interest, divide by 7.5%, it is 40. When you sum up a equity plus debt, you get now what we call the value of the firm from the perspective of equity holder and debt providers. We can therefore say that note the value of the firm increases with increase in debt. The more that you have, the higher the debt is, the higher the value of the firm. That is the argument. And you can note that A has 100 without debt, B has 105 with a smaller debt, and C has 110 with a higher debt. The value of the firm will increase as you increase the debt. I hope that is clear. But now the second question was, what do you think is the cause of this difference? This one. What is the cause of this difference? If someone has a question, let me see whether anyone has a question or any issue. I don't want to... someone is asking, how did we get the equity value? Okay. Yeah, I think that is the only question. How did we get the equity value? When you look at this question, here we are told that earnings to ordinary shareholder is what their shareholders will get. In the question, we are told that the cost of equity here, the required rate of return for the three firm is 10%, and the cost of equity, this cost of equity is 10%. The present value of earning to ordinary shareholders is what gives us the value of the firm. So the value of the firm equity value is this earnings over 10%. For B is 8.5 million over 10, and for C is 7 over 10. That gives us the value of the firm. That is the equity value of the firm. You look at what are you getting. Out of that, you get the value of the firm. I hope your question is well answered. So if that is it, then we need to explain the difference in value of the firm. The difference in the value of the firm, we say that when equity holders are earning at 10%, the debt providers are paid at 7.5%. When you have debt, you pay providers of capital at 7.5%. If the cost of equity is 10, 10% minus 7.5% is 2.5%. That 2.5%, what you save to the providers of capital, is left to the business because you paid the providers of debt less. It is left to the business, and that is what make a farm with debt to grow. The providers of a farm with debt, based on the capital they have invested, they will earn more. And this is what I have explained here. As debt is increased in the capital structure, the value of the farm also increases. This is because the lower finance cost paid to the providers of debt capital as compared to the finance available to the providers of equity. The providers of capital are paid 7.5. So there is a less amount that is getting out of the business. The remaining 2.5% is left in the business. So it makes the business to have a greater value. And this is what we are saying. Interest saving on debt capital is 10%. If it was equity providers, they would be earning 10%. But because you are using debt, they are earning 7.5. So the farm is saving 2.5 for using debt. So we say that the finance cost per annum increases the earnings to the providers of equity. When you pay less capital to the provider, less costs to the providers of debt, whatever is left into the business. And remember, the business belongs to the equity providers. So when the annual finance cost is distributed at the farm cost of capital, the present value explains the difference. And I want to use that illustration to explain. Look at this. Let me have this one. Yeah, that way. I want you to have a look at this. Let me put it well. Good. Finance costs. Okay, let me have it. Let me create some more space. Yeah, like that. I want you to look at this. Farm A does not have debt, so there is no finance cost saving. The providers of capital in A demand 10%. In Farm B, they demand 7.5% on the capital invested. The remaining 2.5% is left to the providers of equity. When you take 2.5% multiplied by 20 million, it gives you 500,000. That one is retained in the business. In the second one, the providers of equity would have been paid 10, but because they have debt, they are paying 7.5. The farm saves 2.5 in cost. When you multiply by the debt, it means that the farm is paying less by 1 million. Now, because this one belongs to the providers of equity, this 1 million in Farm C and this 500,000 in Farm B, the providers of equity will discount using the cost of equity, and that is what I'm giving here. 500,000 divided by 0.10 is 5 million. Then the providers of equity in C, they will take the 1 million. Let me push it a little there. They will take the 1 million, this 1 million, divide by cost of equity to get the present value, they get 10 million. And that 10 million is the one when you compare with Farm A, it explains the difference. You look at it this way. This Farm A does not have any benefit. But Farm B, when you take the value in Farm B, its value was 105. If you look at it here, 105 million minus 100 is 5 million. This 110 minus 100 is 10 million. And that is what is explained by the present value of 500 to get the 5 million. That is 105 minus 100. And when you come to this one, 1 million divided by 0.1, you get 10 million, which is 110 minus 100 million. That is the explanation of why under the net income theory, the value of a farm with debt is higher than the value of a farm without debt. We'll be talking about the issue of taxes later. But now, when you look at it from this perspective, let me put it well. Let me put it here so that at least we can understand it. Good. Let me, yeah, like that. You look at it this way, the cost of debt is here, 7.5. The cost of equity is here at 10%. The weighted average of capital decreases as you increase the debt in the capital structure. That is the basic argument. And that is what makes the value of the farm to increase with gearing. This is called the net income approach. It says when there is debt, the WACC decreases. As a result of that, the value of the farm will increase with the increase in debt. Just basic, straight, like that. We will expound it under the net operating income approach, but I need to see whether someone has a question. Someone is asking, when do we deduct interest in cash flow to get net cash? And when do we not deduct it to arrive at the net cash flow? I think that one we will be referring to the investment, evaluation of investment, not in the capital structure. Because in the capital structure, you are supposed to determine, you are not computing the cash flow, we are dealing with the profits. We will be dealing with it when we go to the computation of the cash flow in investment decision. So let's first deal with the issue of profitability. We will deal with the cash flows in the investment decision, which is a coming topic. So allow me not to go to the cash flows because we might end up, we might find ourselves mixing things. Yeah, just hold it until we get to the investment decision where we'll be dealing with the cash flows. I don't think there is another question. Okay, I want to explain the net operating income. This is the most important because it is the one that takes us to the theory. Net operating income. This one got more. This is where we will introduce taxes. This is where we will introduce the theory. Under the net operating income theory, the capital structure of the farm is said not to be relevant. When we say that it is not relevant, we say that the WACC remains constant. When you look at the first two theories, WACC decreases when we increase the debt. But under net operating income approach, the WACC is ever constant. Irrespective of how much debt you include in the capital structure, the WACC will remain constant. So we are saying that according to this theory, the capital structure of the farm is irrelevant. This is because the amount of debt in the capital structure does not affect the value of the farm. and WACC for the farm. Remember when we started the issue of the capital structure, we said, does debt affect the WACC or the cost of capital? Does debt affect the value of the farm? If so, what is the optimal capital structure? Under this theory, debt does not affect WACC. We will try to prove that as we move, and therefore, it does not affect the value of the farm. Now, what are the assumptions of this theory? The specific assumptions of this theory. Assumption number one is that the cost of equity will change with debt. Unlike the other cases where it remains constant to a certain level, at the net operating income, immediately you bring debt in the farm, the cost of equity starts to increase. Number two, cost of debt is constant. It doesn't change. It is not affected by the gearing. It is affected by other factors like business risk. Then we say that in the initial stages, we will deal with it without tax. After that, we will deal with it with the taxation. And from that perspective, we can try to understand it from a graphical perspective. And I want you to look at it here. Look at this. When you increase debt, if I could say that this is gearing. Let me show you how I want it to look like. If I decided to say that here we have the gearing, we have the gearing like that. As you increase the debt in the capital structure, note that the WACC is not changing. It remains the same as cost of equity for a farm without debt. What increases is cost of equity, geared cost of equity, cost of equity of geared equity. KEU is the cost of equity for ungeared farm. I have explained it down here so that at least we don't wonder what this means. Here we are. KEU is cost of equity for ungeared farm or unlevered farm. KEG is cost of equity for a geared or levered farm, and KD is the cost of debt, while WACC is the weighted average cost of capital. You note that under this theory, cost of equity, when there is debt, it increases with the increase in debt. The cost of debt does not change, it remains constant. The WACC, which is the same as cost of equity for a geared farm, will remain constant through the period. And with this argument, we can comfortably say that the WACC, or the value of the farm, is equal to the earnings before interest and tax divided by the WACC. Let me put them clear. Yes, like that. The value of the farm is earnings before interest and tax. We divide by the WACC because the WACC captures equity and the debt. This is what we'll be arguing out with under the net operating income theory. Now, for this theory, it tries to say that the cost of equity is increasing because the providers of equity are compensated for taking risk. They are compensated when they borrow more because it exposes the farm to higher risk. And as a result of that, WACC will remain constant. I want to explain that part using a small illustration so that at least we can understand it better. And I want to give this illustration to explain how cost of equity is increasing, the cost of debt is constant, and the WACC is constant. Let's look at this. A farm is considering three financing options as follows. Option A, B, C, equity, it is considering to have 100 million equity, or 70 million equity, or 40 million equity. If it has 100 million equity, the debt is 0. If it has 70 million equity, debt is 30. And if it has 40 million equity, the debt is 60. In any case, its capital employed is the same. So I can say that this is capital employed. The capital employed, like that. The capital employed, because the firm is only considering, do we have less equity and more of the debt? Then we are told that whatever the capital, the rate of return is 15%. So the rate of return, earnings before interest and tax, is 15% of the capital employed. Now the question is, determine the cost of capital and the WACC for this firm. I want you to take 1 minute, look at it, 30 seconds, look at it, then I explain the solution so that you can understand. So I hope you've looked at it. I want us to try and work on it together. We need to see what is earnings before interest and tax. We pay interest. We see what is left to the providers of equity, and that will help us to determine the cost. First things first, because we have three financing options, A, B, C, the earnings is 15% multiplied by capital employed. The capital employed, like that. And I want to make it very clear this way, that way. The capital employed is 100 million. So we take 15% times 100. It is constant because the capital employed is the same. What differ is the interest. Under the first option, there is no debt. 7.5% of 0 is 0. 7.5% of 30 is 2250. This one. 7.5% of 20 of 30 is 2250, and 7.5% of 60 is 4.5, This is what we will pay to the providers of equity, of debt. Earnings before tax, there is no taxation. Whatever remains down here belong to the equity providers. That is earnings attributable to ordinary shareholders. I can put this one here so that at least it can have a clear visibility. Like that. This is what the providers of equity will have. This is what the providers of debt will have. There is no tax. Now, how do we determine the cost of equity? Cost of equity, since the providers of equity in A will take 15 million and the total equity is 100 million, this one here, we take 15 over 100. The cost of equity is this 15%, this one. Under the second case, the providers of equity are getting this 12.75 million. It is the one here. The equity in the capital structure is given as 70 million. So what the providers of equity will take home is 12.75 over 70. It is telling us that the cost of equity has increased from 15 to 18.2. In the third case, they are earning 10.5 and the debt is 40 million. The equity is 40 million. This one, equity here. In C, it is 40 million. So when you get what they are taking home, which is 10.5 million over 40 million, the cost of equity becomes 26.25. You agree with me that cost of equity is increasing. It is 15, we have 18, we have 26. How much is the WACC? WACC. The WACC, we say that the weighted average cost of capital is equal to cost of equity, weight of equity, plus cost of debt multiplied by the weight of debt, like that. The cost of equity, we've said that is 15. The cost of debt is the interest rate, which is 7.5%. Because we don't have tax, we will just take it the way it is, 7.5. Now let us try to get the first one. WACC for option A is 15% cost of equity multiplied by equity is 100% out of 100% plus 7.5% times 0 over 100. It is giving me 15%. In the second case, the cost of equity is this 18.2. Remember, we had 70, this 70 out of 100. So 18.2 times 70 over 100 plus 7.5 is the interest rate times 30 over 100. It is giving us 15%. And the third option, we have the interest, the cost of equity is 26, divided by equity is 40 million over 100 plus 7.5 is the interest multiplied by the 60 million debt over 100. It is giving us 15%. What does this mean? It means at all levels of debt, WACC is the same, cost of debt is the same, but cost of equity is increasing. That is what I explained earlier, and this is how we have it. 2.6, 18.2, 15%. Our WACC is the cost of equity before gearing at 15%, while debt remained constant at 7.5. This graph summarizes everything to do with that. But now, what is the relationship between debt and equity, or cost of debt and equity? That is what I want us to look at by incorporating what we call the Mira and Modigliani. We say that the net operating income theory has been expounded by Milton Mira and Franco Modigliani in their proposition usually known as the MM preposition. That is what I introduced last time, and I decided to take a longer route so that we can see where we come from. We are looking at the Mira and Modigliani. We start with the first argument of Mira and Modigliani. We see what it is. What is important is the concept. You understand the concept. And that is what I'll be explaining for Mira and Modigliani, so that we are able to answer the questions that are in the past paper and the ones that will be in the exam. Before we embark to that, I need to see whether someone has a question. Someone is asking that the debt is constant and does not affect the value of the farm. When do we, okay, that one we had looked at. So the question is, under the net operating approach, debt is constant, yes. The debt is not changing. The cost, not the debt, the cost of debt. Debt is changing. What is not changing is the cost of debt. Interest rate is the same, irrespective of how much you borrow. The value of the farm is determined by WACC, and that is what I was trying to argue, that if the earnings before interest and tax is constant and the WACC is constant, then the value of the farm will not change. Cost of debt will not change, is 7.5 throughout. When you have 10% gearing, 40%, it will remain the same. When you say debt is constant, is it equal to the cost of debt? I say the cost of debt is constant. KD, yes, it is the cost of debt that is constant. Debt is not constant. Debt is increasing. You can borrow more, you can borrow less. But cost of debt, interest rate is not affected by the amount of debt. That is what it means. I believe your question is answered. I cannot see any other question. Okay. Let us now go to this. The MM proposition basic argument is, what is value of the farm? We said that Mira and Modigliani in their first proposition dealt with the value of the farm. They argued that there are no two farms which can attract different values because one is geared while another one is ungeared. But they also admitted, in case this one will happen, investors will practice what we call an arbitrage process. I agree with Mira and Modigliani on that one, that investors practice arbitrage process. What is arbitrage process? If today you went to the Luanda Stock Exchange, you identify two banks that are considered to be of the same size. And when you talk of the same size, is by capital structure. And a very good example is the Nairobi Securities Exchange, Equity Bank, and KCB are of the same size. And when I say of the same size, is that today, if you look at the balance sheet of Equity and the balance sheet of KCB, the difference is so minimal that we can say that they are of the same size. When you go and look at these two companies, are their share prices the same? No. That is where an arbitrage process goes. As an investor, when one of the company that have the same capital structure with the other one has a higher market value, you are supposed to sell the higher market value. You go and buy the one with the low market value. As a result of that, because many investors will do that, the investors with information about trading, they create high supply in the market and the demand increases. The price of the other shares that are being demanded will start increasing, while the price of the shares with high price will start going down. They will change. Then the process will be repeated again. This goes until the point where you get the same value of the companies of the same size in the same industry. And to that effect, the arbitrage assumption, the arbitrage process assume that the capital markets are perfect. Both corporate firms and individual can borrow any amount of money at the same cost of capital. And three, corporate borrowing does not affect the corporate borrowing has the same effect, or simply interest rate is the same whether you are an individual or a corporate. But that is not much important. What is important is this arbitrage process. Under this assumption, the arbitrage process is as follows. If you are told to explain an arbitrage process, number one, an investor sell his shares in the overvalued firm to get money, to get cash. The investor go back to the market to borrow at the personal account. They will go borrow an amount that is equal to the percentage they own in the overvalued firm multiplied by the debt in that firm. This one I'll explain with an illustration so that we can understand. Then the investor will make a comparison of investment of whether to invest in the undervalued firm or the overvalued firm. Then the investor will invest where the returns are maximized. I want to use an illustration to explain this because it is a little technical and I would want you to understand. Look at this illustration. Consider two firms, A and B. Earnings before interest and tax for each is 100. Interest for A is 0. Interest for B is 15. That is 5% on 300,000 debt. Then earnings after tax of A is 100. That is 100 minus 0. The earnings after tax of B is equal to 85. In this case, we still are assuming there is no tax. That is why I call it earnings after tax. The cost of equity for A, the one that does not have debt, is 10. And because we say the cost of equity will increase, the one for B is 11. But now what is the question? Determine the value of each firm. And number two, explain the arbitrage process and compare the return of the investor who holds 20% in firm B. If all the available funds are invested in A, and if he maintained 20% ownership in A, I want to explain this question because we need to understand the question. Let me put it this way. I want to squeeze it so that it is visible. Yeah, good. When it is like that, it looks a little better. I want you to look at it. Look at it. 1 minute, 1 minute, look at it so that I can explain. Just look at it. Good. If you have led through that question, I want to explain it so that we understand. Someone is asking, where is the 300 coming from? The farm B must have a debt of 300. That is what it means. That the farm in its capital structure, it has a debt of 300,000. So that when you take the interest rate times is 5%, earnings after tax or earnings before tax less tax, you get the same. Cost of equity is 10. Cost of equity for B is 11. Determine the value of the farm. The value of the farm. We say it, value of the farm, the providers of equity will divide by cost of equity. The providers of debt will divide by the 5% cost of debt. That when we add them, we get the value of the farm. And this is how it is. A, value of equity is 100 over 10%, while this is 8500 over 11. It is explained by the earnings to ordinary shareholders is this. 100 over 10 and 85 over 11. That is how equity provider perceive it. For A, it will be 1 million. For B, it is 772. The debt, A does not have debt. Value of debt, A does not have debt, so interest of a 5% is 0. But B has 15,000. It was actually 15,000 debt. Divide by 0.05, this one here. This interest, divide by the 5%, you will get 300. Here, this 300. Now, the 300 here, when we add 772, we get 1072, 727. This one, we take the 1 million, we add 0. Maybe I can push this one a little there. Let me have it so that it can be clearly visible. Yes, like that. We add 0. This one, I can have it again here, like that, that way. So interest plus value of the debt, this is value of equity plus value of the debt, this is the value of the farm. This value, this here, we should have it here. So that value of the farms, value of the farm. We got farm A is 1 million, farm B is more than 1 million. And we say that they are identical farm. This is the example I was giving of Equity Bank and the Kenya Commercial Bank. If one of them has a higher value, the investors should practice arbitrage process because they are argued to be of the same size. So we are saying that the two firms being in the same industry should be of the same value, but firm B has a higher value. Hence, it is said to be overvalued by the forces of demand and supply in the market. B is having a higher value. It is overvalued in the market. The market has given it more value. If those two identical firms, one of them has a higher market value than the other, we say that that firm is overvalued in the market. What do? We practice arbitrage process. What are the steps of arbitrage? This is what I want to explain. As I said, by the theory, we would not have understood better, but computation, we will understand it. Number one, since B is overvalued, this one, B, the investor shall sell the ownership in this firm. Remember in the question, we are asked, Explain the arbitrage process and compare the returns of the investor who holds 20% in Farm B, assuming all the available funds are invested in A. B, if he maintained 20% ownership in Farm A. That is what I want to explain. The first step is sell ownership in B. Sell ownership in B because it is undervalued. He has shares in B. He will sell 20% that he owns multiplied by the value of Farm B, the equity value of B. Let's look at the equity value. This is the equity value, 772, 727. He will sell his ownership, 20% of that equity, and this is the money he will put in the pocket. He will have cash. Now he is not a shareholder in any company. But remember, being an investor, the arbitrage advises that when you sell shares, borrow money to increase your money. So borrow at an amount equal to the percentage of his ownership, which is 20 times debt. He owns 20 multiplied by the debt in B, the 300 you are asking about, and which we determined here as the value of the debt. He will go and borrow an amount equal to 20% percentage ownership multiplied by the debt in that farm he wants to run away from. He will have a total amount equivalent to the proceed of sale of shares and the amount borrowed. These two amounts, the amount available is this, the sum of the two. That is what this investor will have in cash. But again, remember, this is an investor. Although he has cash, he needs to ask what is the best way forward to invest. That is step number 3. Invest in Farm A because A is undervalued. The argument that he will have, because I have 214, 545, can I invest the entire amount in A? If he decides to invest the whole amount, he will take 214, 21, 214, 545.4, invest in equity of A. Equity of A is this 1 million. This 1 million is the value of equity. He will buy out of this. What will be his percentage ownership? It is the amount, 214, or this one should be 1 million multiplied by 100. He will have 21.45%, which in B, he had 20%. But when he borrow and invest the whole amount, after selling the ownership, his percentage ownership in A will come to 21.45%. That is the argument. Sell the ownership, borrow, and invest all the money. His percentage ownership will increase. He will become a shareholder with a higher percentage. The other option would be if he feels, I just want to be a 20% investor in A as I was in B. This is the argument here. If he decides to maintain his percentage ownership, his 20% ownership, then the amount spent will be as follows. He will invest in B 20% of the capital in B, of equity in B. He will invest 200,000, but remember he has 214. He will have some idle cash, 14. The balance is 214, 545 minus 200. That will give 14 is idle cash. Then let us do an analysis to see the impact of the return. The impact of the return out of the 3 possible decisions by this investor. I want to make it in a way that I'll display it in a single page. So let me do this. Let me try to squeeze it so that you can see it fully on a single page. Good. This investor was in A. Look at this. He was in A. In B, sorry. He was holding 20% in B. When he was in B, he sold his ownership. But as he was in B, there is that what he was earning. So he will remain, if he remained in B, we need to ask ourselves, what was he earning? If I go to B, let me put it this way, earnings to ordinary shareholders in B, I want to give it here, this one. Can you see this? The providers of equity in B were getting 85. The providers of equity in A are getting 100. So when he was in B and he held 20% shares, his earnings share of profit was 20% of 85. That is what I'm trying to explain on this table. He was earning 20% of 85, this part here, which is 17. I believe it should be 17,000. When he go to A, he can invest the whole amount to become a 21.45% shareholder, or he can retain 20% in A, meaning he will have idle cash. So if he invests 21, what will be his profit? His earning? The earnings to ordinary shareholder in A is 100. He will get 21.5% of 100. In this one, he will get 20% of 100. That is, investing the whole amount, he will have a share of profit, 21,450. If he decides to retain 20%, he will have 20% of 100, which is 20,000. But remember, this person borrowed some money. He borrowed. Remember, he borrowed 60,000. He has a loan. There's 60,000. There's 60,000. So he will have to pay interest on the 60,000. That part of paying the interest is what will determine the net income. Let me first check the questions so that I can see whether we are together. Someone is asking, how do we get 10%? Which 10%? Maybe which 10% is that? Okay, maybe you can tell me which 10%. The other one is value of the farm for debt. This is not the value for the farm for debt. It is value for the farm for equity. Equity holders are getting 85,000. Cost of equity is 11. So if you are to determine the value of the farm for equity, it is the one, the 85 over 11. So I believe there was a mistake. Value of the farm for debt is for equity providers. How do we get the 10,107? This 107 here. I believe you are asking about which one? You're asking this. This is equity. 777 plus 772 plus 300. That is how we are getting this one. I believe that is the question. This one. Let me see whether there is another question. Someone is asking, what is the purpose of arbitrage process? It is a practice by investors in the market. It helps you to make investment decision. That is its purpose. You don't hold overvalued shares. You put your investment in undervalued. Make investment decision, and it is real. Oh, what did I do? Someone says it doesn't make sense how he invests at a valued company. Well, I don't know what you mean. It doesn't make sense. It will make sense when you're answering the question in the exam or when you are investing. We are evaluating. We are evaluating. So let us continue with the evaluation. So this investor has decided to invest in A. I don't know how you say it doesn't make sense. Statistics shows that, shows otherwise. Maybe you have your own view because statistics has proven otherwise. If this investor goes and invests the entire amount, remember he had a loan, will pay the 5% of 60, whether he maintained 20 or 21. The net income, this is the net income for this investor. When he was in B, his net income stood at 17. If he decided to maintain 20%, his income remained 17. But if he decided to invest the entire amount and pay interest, his income increases to 18,450. If you want to advise this investor, tell the investor to practice an arbitrage process, but invest all the money because the return will increase. So NB, if for some reason the value of the geared farm, okay, that is the vice versa of the same, and geared farm is greater than the value of the geared farm, then the arbitrage process will operate in the opposite direction, but that is a rare case. This is explaining, even to those who believe that investing in undervalued farm does not make sense to them, statistics shows that when you invest in undervalued farm, you will earn more under the arbitrage process. If you continue in the overvalued farm, you will earn less, and hence you should practice an arbitrage process, but invest all the money in the undervalued farm. I don't know whether there is a question before we get now to serious issues of taxation. Let me see whether someone has a question. Before that was explaining the value of the farm, what value you get by making the right investment decision. The question, do you mean that if he remove only 20% from B, will win 17%? He was earning 17% when he was in B based on the rate of return, or will be winning 34, 17 for A. No. These are independent companies. You are only investing in one. If he invests, he remain in A, in B, he is earning 17. So if he leave A to go to B, he will earn 18. They are independent companies. What is someone asking? I believe this is, what is debt in company B? 500,000. It means that to make arbitrage pricing happen, investor will take percentage of investment multiplied by amount of debt to get amount to invest. your question is very valid, David. Very valid question. The debt in B is 300, not 500. This one. Remember, there's someone who asked where the 300 came from. This is the debt in B. It is not 500. It is not 500. Even when you determine value of the debt, it gives us 300. The question you are asking, I think you needed to confirm whether it is 500. It is 300, not 500. It means that that to make arbitrage pricing, it's not pricing, it's process. Arbitrage process happen, investor will take percentage of investment multiplied by amount of debt. Perfect. That is what it means. That is what an arbitrage process is. That's what it means. Yes. Get amount to invest in company. Yeah, that's correct. So how we know the farm is geared or ungeared? A farm is geared if it has debt. A farm is ungeared if it doesn't have debt. When he decides to borrow 60,000, how will he benefit from borrowing? We've seen he will earn more, pay less interest. We said cost of equity is more than cost of debt. You can borrow at 15%, you become a shareholder to earn 18%. So he will earn more and pay less interest. With the illustration, it does make sense. Okay, thank you. Sunday says, now you understand. Perfect. That's good. That is why we are doing the illustration, to make everyone understand. Okay. When he invests 20% in B, there are remaining amount. He did not invest. Why don't you incorporate? No, in B, he was in B. He had not borrowed. He was in B with his money, but he want to run away from B to go to A. That is why arbitrage advice, go and borrow, do some borrowing. It is a guide by the arbitrage to help you make more money. So in B, he wasn't. He was not having loan. He borrowed when leaving B. I think we are following. When I see those questions, it can tell you that people are following. And again, I see today you are 100% present. A full 106 students are in class. This is encouraging. To help me understand APT. I impose another debt to help me understand APT well. Do I understand this question? David, you can reframe your question. It is not very clear. It is not very clear. Okay. I think I need to understand your question. Yes, we are moving on well. We are moving well. People asking questions. It tells me that people are following. I don't know. Okay, I see someone, but this was some 20 minutes ago. I don't hear you. The problem must be on your end, or is there any other person who cannot hear me? Fred, should we conclude that Farm B is overvalued due to... No. Farm B is undervalued. So is it? Let me check. Let me see, what did we get? No, sir, Farm B is overvalued. Or you're asking, should we conclude that Farm B is overvalued due to debt? In the next level, I will demonstrate the difference where you have a farm with debt and without a debt. You see how is it overvalued. Good. The other question I see here. Are you asking whether I can make a summary? I think, yeah, the summary is better explained by this table, this one. When you are in overvalued farm, sell the security in B because it is overvalued, go to farm B, the one that is undervalued. And it is overvalued because when you determine the value of this farm, this value is 1072, while this one is 1 million. And they are identical farm in the same industry. So B is overvalued. Move from overvalued farm, go invest in undervalued farm. I hope I have answered what needed to be answered. We can move to the next item. Someone is saying that a value of farm B 85 over 11%. Where was this? 85 over 11% is not, or 85 over 85,000. What did I use? Let me see. The providers of data are getting 8,500. 8,500, not 85,000. I gave 8,500 over 11%. I don't know where the difference is coming because I used 8,500, not 85,000. Why do you think it is? Is it 80? No, it is not 85,000. Can you put that in your calculator? Put that in your calculator to confirm the answer. 85 divided by 0.11. 85,000. Oh, let me check. Oh, yeah, I see your argument. Thank you. This one, this is where you are disputing, which is very correct. It is 85,000, not 8,500. Yes, but the answer is correct. The computation is correct. That was a typing error. As an accountant, you should always make typing errors. You are not a secretary, you are an accountant. As long as the figures are correct. So, yeah, thank you for that. Thank you for that observation. That was good. I had not looked at it from that perspective. Yeah. Okay. A farm is undervalued because its market value is small. A market is overvalued because a comparable farm has a higher value. We explained the amount invested of 21,4545 as the amount borrowed and the amount we sell the equity. Someone says that you want me to write NB. What do you want me to write? Thank you, Sandy, for confirming. Why do you want me to write the NB? And you can see it. I'll share these notes. Thank you for those who are correcting the 8,500 to 80. In fact, if you go through these notes and with what I have explained, you should get it so well. I also allow you, keep making some notes. Have a notebook and make some few notes that will help you remember what we did. Yes, it is good also to make some notes. Someone can make some short notes. I think that one, the questions were many. And that tells me that people are following. People are following, and that thing must be well explained. When I see 100% attendance, I feel like we can go up to 11 p.m. Kenya time or even midnight. But anyway, we cannot exceed beyond the normal time. So let us go to second proposition. This is where the reality came. And the reality is, let us talk of taxes. Let us talk of taxes. In the initial investigation, Mira and Modigliani maintained that the capital structure is irrelevant. Therefore, they agreed on the net operating income approach. In the second proposition, in the second proposition, they are concerned with the determination of formula for calculating the cost of equity in a geared firm given a cost of equity in similar ungeared firm. This is explained graphically below. This is what Mira and Modigliani said. When you have debt, let me do something. I want to push this one here to make it better possible, like that. Yeah. As you introduce debt in the capital structure, the cost of equity for a geared firm is increasing. The cost of debt will remain constant, and the WACC is constant. What happened is that difference between cost of equity for ungeared firm and the cost of debt is given to the providers of equity. As a result of that, they came up with this summary. I want us to look at this summary here. We say that KEG is cost of equity in a geared firm. In a geared firm, KEU is cost of equity in ungeared firm. KD is cost of debt. KD is cost of debt. Now, summarized the formula. These are the very important formulas that you should always remember. Let me try to squeeze them so that they can look a little professionally done. Good, like that. Look at these two formulas. I want to make them bold. I want to give them a good color for visibility. Yeah, like that. That way. Good. Cost of equity for geared firm is equal to the cost of equity for ungeared firm plus cost of equity for ungeared firm minus cost of debt multiplied by debt over equity. This is when there is no tax. When there is tax, we take the first one, we multiply by 1 minus tax. That is in the presence of taxation. These are the formulas that gave in determining the cost of equity for a geared firm given ungeared firm. The argument is whatever is saved from debt, it increases the earnings to the providers of equity. And this is the argument. The finance cost saving, which is cost of equity for ungeared firm minus cost of debt, is used to compensate the equity holder for the financial risk taken. When you borrow, you put more money in business at a lower cost. That saving is left to the equity holders. The company's overall risk level to the investor is as it was before gearing. Hence, now when you compensate the providers of equity, you pay them, you compensate them, they will look at the firm like it doesn't have debt. They feel compensated of the risk undertaken when you compensate them. And that is why investors, the equity holders, are comfortable with a geared firm because they will make more money. They don't feel the risk. Then later on, when incorporated taxes, they concluded that the effect of the interest tax shield benefit of using cheaper debt finance makes geared firm to be more attractive. The providers of debt will look at a geared firm as better firm than a firm that is not geared because they are earning more. Now, we say that makes geared firm to be more attractive than ungeared firm. Therefore, in presence of taxation, equity shareholders in a geared firm enjoy interest tax shield benefit. They enjoy interest tax shield benefit besides the cheaper debt. If you are having debt in your capital, in your firm, you will pay providers of debt less, so you will have more benefit. In addition to that, interest is allowable for tax. You will save on tax. That is another benefit. So when there is taxation, providers of equity benefit twice. One, saving from interest, and number two, they benefit from saving on taxes. That is the argument that they had, and it is very valid. Consequently, in the presence of taxation, the equity shareholders will now perceive geared firm to be less risky and of higher value than a similar ungeared firm. This is the conclusion, that value of a geared firm is greater than the value of an ungeared firm. Value of a geared firm is greater than the value of a geared firm. This way, value will pass less risky and will be higher value than the value of a similar and geared firm. So perceive a geared firm. I want to put this one in bracket. A geared firm, value of a geared firm is higher compared to the value of similar and geared firm. This one I want to put it as value of similar and geared firm. So value of a geared firm is greater than the value of an geared firm. Investors like firm with debt, and that is why investors at Mira and Modigliani, they like borrowing because the firm will have a higher value. Now, in conclusion, concluded that in order to prevent investors from practicing an arbitrage process, the excess value of geared firm above a similar firm that should always be restricted. Now, that excess value, if I say that the excess value of geared firm above similar and geared firm, this one I can put in bracket as value of a geared firm minus the value of ungeared firm should be restricted. This is the excess value. This is the excess value. Excess value is equal to value of a geared firm minus value of an ungeared firm should always be restricted to present value interest tax shield. The providers of debt in a firm that is geared have two benefits. Benefit number one, lower saving on interest. Benefit number two, is interest tax shield. That interest tax shield gives a higher value. When you discount it, you get the difference between value of a geared farm and the value of a geared farm. And this is what we call is restricted to the PV. Let me put this one in full as present value of the interest tax shield benefit. I want to demonstrate the present value interest tax shield benefit, and this is its explanation. The present value interest tax shield benefit, we say that it is the annual interest tax shield divided by the cost of equity. And how do we get annual interest tax shield? It is interest rate times debt times tax rate. When you divide it by the cost of debt, it means the present value interest tax shield is equal to cost of debt times tax rate. If you cancel this cost of debt with this cost of debt, you are left with the debt times tax. Now, all that is not important. What is important is present value interest tax shield is equal to debt times tax rate. If I could summarize it down here, I can put it this way. Present value interest tax shield is equal to the debt times tax rate. Present value interest tax shield equals debt times tax rate. So therefore, according to MM, okay, the value of a geared farm is equal to the value of a geared farm plus present value interest tax shield. And this is the final argument that they did. Value of a geared farm is equal to value of a geared farm plus present value interest tax shield in case the value of a geared farm, is greater than value of a geared farm, let me put it this way, value of a geared farm plus present value interest tax shield, then investors shall practice an arbitrage process. They will practice an arbitrage. It is acceptable. Value of a geared farm is greater than the value of a geared farm, but this one should not exceed value of a geared farm plus present value interest tax shield. In case it is more, investors will practice an arbitrage process. I want to explain this or to demonstrate this using an illustration so that you can understand. Let us demonstrate it with an illustration. If you can see here, I want to demonstrate illustration. Let me squeeze it so that I can display the whole of it. Let me just squeeze it well. Consider the following two farms with the following characteristics. Farm A and B. Both have earnings before interest and tax of 100 million. Farm A has debt amounting to 600. That is 5% debt is 600. B does not have debt. Cost of equity for A, which is geared, is more than that of B. The tax rate is 40% for both. Required. Determine the total market value of the two firms. Determine, let me use this word, determine the market value. Okay, let me go by this. Determine the total market value for each firm. For each, excuse me, for each of the two firms. Determine the total market value for each of the two firms. Now, B, assume that an investor owns 20% in firm A. Determine how the investor will practice an arbitrage process. I want you to read through this illustration because I will use it to demonstrate what is value of a geared firm, value of an geared firm with the present value interest tax shield. Just read through it so that I can explain. Now, someone is asking, there's a question I had seen. Something I wanted to respond to. Okay, let us first work out the question together. Let's work out together the question. I will see the questions that are there. Okay. The question, we are told that consider the following two firms with the following characteristics: firm A and B, earnings before interest and taxes. Then A has debt, B does not have debt. Cost of equity for A is 10.5%. That one for B is 10%. Tax rate is 40% for each. Determine the total market value for each of the two firms. Total market value for each of the two firms. Equity value and the debt value. By the way you look at from where you stand, can you try with all that we have done? Can someone give me the value of A and the value of B? I think that is what I should have asked. Give me the value of A and the value of B so that I see whether you are understanding. Compute, just post value of A, value of B. Compute that one. I need to see your argument. Someone to share the value of A and value of B. Just compute. I hope you can hear me. I hope you can hear me. Can you hear me? Can you hear me? Someone, okay, yes. Someone says the value of A, someone would written that. Value of A is it 57,000 or 570? B is 60,000. A is 57,000. Value of B is 6 million. Remember, this is with the taxation. Let's look at it together. Let's look at it together. The first thing is to determine the income. The first thing is to determine the income. And here are the incomes. One, each of the firm has earnings before interest and tax of 100 million. But A is geared. It has a debt of 600. Its interest is 5% times 600,000 debt. It has a debt of an interest of this much. Let me put it in bracket to mean that I'm deducting like this. B does not have debt. Earnings before tax for A is 70, 100 minus 30. For B, it is 100. We less tax at 40%. At 40%. At 40%. 40% of 70, that is 28. Like that. Then we have 40% of 100. That one is giving us 40. We minus. I put it in bracket to minus. 70 minus 28 is 42. 100 minus 40 is 60. Now we need to get the value of the firm. Let me squeeze them for clear of visibility. I want to squeeze them together so that you can have a clear visibility. Good, like that. Okay. Value, remember the cost of equity for A, if you go back to the question, was 10.5%. This 10.5%. The one for B is 10. If you want to get the cost of equity, I don't know. Oh yeah, I hope you can hear me. I hope you can hear me. I wanted to see whether I'm on mute. So the value of equity for A is this earnings after tax. We say that is the earnings to ordinary shareholders. To ordinary shareholders. It is the earnings to ordinary shareholders. That is the earnings after tax. This amount is the one we divide by cost of equity to get the value of equity. So the value of equity for this is 400. For this one, we divide by the cost of equity is 10%. It is 60,000 divided by 10%, giving us 600. That is how it is. That is how it should be. Then from there, we determine the debt value. A is geared and it paid interest amounting to 30,000 and the cost of debt is 5%. 30 over 5 is 600. B is not geared. As a result, the value of B, B is equal to the equity value, which is 600. This 600 plus 0 is 600. The value of A is 400 plus 600. It is 1 million. That's how it is. Now we look at A and B. My question is, from what you see, is A or B geared? That cannot be answered. When there is taxation, you don't just look at them the way they are. A is geared. To determine whether it is overvalued, we say that the value of A should be equal to the value of B plus present value interest tax shield. And this is what we have here. According to MM, the value of a geared firm A is equal to the value of a geared B plus present value interest tax shield. So the value of A is value of B plus present value interest tax shield. And what is present value interest tax shield? It is debt times tax rate. For 600,000 is the debt. This debt times tax rate is 40%. It should be 240. So the value of A should be equal to the value of B, 600 plus 240, according to MM. This is what we have down here. Value of A is equal to 600 plus 240 plus 600, which is 840. But now, when you look at our computation, value of A is 1 million. It is more than MM valuation. We say that A is overvalued. We are saying that the value of firm A is 1 million, meaning that firm A is overvalued and the arbitrage process will take place to restore the value of firm A to equilibrium. That is the argument. The value of A, you compare it with the value of B plus present value interest tax shield. That is the argument. I don't know whether there is a question. Any question? Let me check on the question side. Value of B is 600. That is what my earlier question. I believe now you understand how we go about the argument. Those who had given value of B as 600, they had gotten it right. Value of A is the one that was disputed. Let us argue the arbitrage process. In the question, if you look at the question, we are told that assume that an investor owns 20% of firm A. Determine how such investor will practice arbitrage. We say number 1, sell ownership. Number 2, borrow 20% times debt. Number 3, compare the return on investment by investing the whole amount and retaining the 20% in B. Let's go down and confirm that. Arbitrage process. The investor in A shall sell the ownership in overvalued firm, which is A, to realize cash. Sell 20% of equity. Ownership is equity. Equity in A was this one. You see this one, this 400. sell your 20% on 400. 2, after you've sold, you will realize the cash, and which is 20% times 80. Step 1. Step 2, borrow an amount equal to 20% on debt in overvalued firm. That is 20% multiplied by 600,000. Because the debt in A is 600, remember we computed here 600. Borrow 20% of 600. This person has a loan of 120 and had 20 from sale of equity. That means the total amount this individual has is 120 plus 60. This individual has 200,000. Let us make an analysis of investment. Invest in the undervalued firm B. But when investing, you can take 2 options. Option number 1, if he invests the whole amount, remember he has 200 and firm B equity is 600. If we went back here, equity of B is 600. What will be the ownership of this person? It is the amount of 200,000 divided by the 600,000. This one. This person will have that 3.3%. Remember, in A, he was at 20. In B, he will be at 33. But he can make another decision. He can decide to retain 20%. If he decides to maintain his ownership of 20%, the amount spent is 20% multiplied by the equity in B. He will invest 120 and he will be left with the idle cash amounting to 80. Let us compare the return. If this investor, when he was in A, he was earning cost of equity 10.5% times 80,000. Cost of equity times 80,000. What he was holding, this was giving 8,400. He did not have a loan, less interest. The net income stood at, this is net income. Net income stood at 8,400. The other option is, if this person invested in B after borrowing, and I want to explain the effect of taxation. Let me try to squeeze it. Let me try to squeeze this one so that we can relate. Okay, look at this. When this person go to B, if he invests, if he maintain 20%, let me put it this way, maintain 20% in B. Maintain 20% in B. He will invest this. If he decides to maintain his ownership of 20, he will invest 120. So he will get cost of equity in B times 120. He will get 12%. Remember, he had borrowed 120 from here. Borrow in personal account. Remember, we said here, borrow on personal account 120. He had borrowed 120. So when you come here, he will have 5% times 120, but remember, there is the fact of interest, 1 minus tax. This is 1 minus tax. 1 minus tax. We take 5% times 120, multiplied by 1 minus tax is giving 3,600. If he maintain the 20% in B. The net effect is the same, but I want to demonstrate. Let me demonstrate the other one. Let me demonstrate it down here so that we can see the argument. I want to demonstrate it here. Invest the entire amount. Let me do this. I want to make it good. I will remove this instead of repeating. Instead of repeating this. Yes, good. Then I'll say here, invest the entire amount. Invest the entire amount. Invest the entire amount in B. Like that. The entire amount in B means the percentage ownership is how much? We computed the percentage ownership, that 3.3%. This is that 3.3%, like that. That 3.3%. So how much will this person get? He will get 10%, this time not of 120, but of the entire 200. 200. This is 20. This is 20. Less interest, he will still pay the interest. How much is 20 minus that 600? 20 minus 4 is 16. So is this 16,600? Someone to confirm for me. 20 minus that is 600. I believe it should be that is 600. That is the net income. When you look at it, this investor should invest the whole amount in B, because maintaining a 20% will make the income to remain constant. So we say that the investor should practice the arbitrage process and invest the entire amount in B to increase the net return. The net return, like that. The investor should invest the entire, practice the arbitrage process and invest the entire amount to increase the return. And that is the argument under the arbitrage process in presence of corporate tax under Mira and Modigliani. I want to see whether someone has a question. Is 16,400 not 16,600? Yes. Oh yeah, I actually had asked a question whether it is 16. Yeah, it is 16,400. Thank you. 16,400. 16. Yeah, that's correct. That's correct. That is correct. A 16,400. Thank you. Thank you. Thank you. Thank you. Okay, that error is well noted and corrected. Now, that one is an implication when we talk of the corporate tax. I have tried to give the arbitrage, not the arbitrage. Mira and Modigliani, we understand where they came from when they were arguing about taxes. I want to add another tax, and this is personal taxes. Oh, time is going too fast. I haven't given you a break. So let us, before I introduce this, I want to give a 8-minute break so that we come and finish. We are almost finishing. If I finish this one today, I will be happy. And we are almost. In a few minutes, we'll be finishing. I want to give you some 8-minute break. Then you take a cup of tea or some coffee. We finish so that tomorrow we can deal with the questions. Let us take a break, 8 minutes. We are back in a moment. We move to the last part. Someone is come again on why you took 200 divide the number. 200 divide the amount of debt when calculating the percentage of ownership if he invested. Yeah, this person borrowed an amount of 120 and he had 80 from equity. His total amount, the cash he had, is 200,000. That is what he will invest in the next farm, and that is why we need to see what percentage will this person have. It is what he has divided by equity in the new farm. That is why we divided 200 here. If the person invests the entire amount in the equity of the undervalued farm, what will be the percentage ownership? That gives 33. I think that is the question that you are asking, why we divided. Someone says you cannot hear. I don't know whether you can hear me. Am I audible? Can you hear me? Let me know whether you can hear me before I get to the next item. Yes, yes, yes. I can see people responding that they can hear. Yes, yes, yes. It is not A who take debt. Someone says that, but it's A who take debt, not B. No, it is not A. It is the investor with the 20% ownership in A. The investor is the one who is taking a loan. A and B are companies. So it is not the company that is taking a loan, it is the investor. Make sure that you understand that. Now, good. That is how it is. It is the investor who is taking the loan, who hold 20% in A, not the farm. Allow me to take you next. And the next thing we look at here is incorporating personal taxes. Excuse me. Incorporating personal taxes. And we say that when personal taxes are incorporated, they are taxes that are paid on income to the investors. When you buy shares, you are paid dividend. When you invest in, so when you buy debentures, you are paid interest. The net amount that you get, you are supposed to pay some tax on that. That is where the issue of personal taxes is coming. The tax on the income that you get, both from the shares and from the interest. That net income net or combined earnings is the one that you tax. So we say that net income is equal to the interest plus dividend minus personal tax. So we are saying that while the additional benefit in the farm in form of interest tax saving will be obtained as interest tax benefit, we say that the net income will factor in 1 minus personal tax. And I want to explain this. I want to explain it with an illustration so that at least we understand. Look at this illustration here to demonstrate what I mean by personal tax. Illustration. Consider the following two identical farms A and B with the following characteristics. Earnings before interest and tax for each is 1 million. Debt in A is 2 million. Equity in A is 8 million and B is 10 million. That means capital employed in A is 2 plus 8 is 10, same as B, which is 10. Cost of equity in each is 10, 10, and the tax part of the question before we think about it. Then down here, I will use the personal taxes on the same. Assume that there is a personal tax rate of 40%. Determine the combined net income to the provider of the debt. Let me actually put this question here. A, required. A. Then I say required. B. I want to put it here. So we say that, let me put it this way, assuming that there is a personal tax rate of 40%, determine the combined net earnings. Now let us work on it together. Determine the total earnings to the providers of capital in each farm. Here we are told that consider the following two identical farms, A and B, with the following characteristics. A, earnings before interest and tax is 1 million, B is 1 million. A has a debt of 2 million. I can actually put it this way, has a debt of 2 million, while this other one does not have a debt. Equity in A is 8 million. The equity in B, I can make it like that. The cost of equity in A is 10 and in B is 10, while tax rate, let me say that corporate tax rate is 30%. That sounds better. Determine the total earnings to the providers of capital in each. The total earnings is A, earnings before interest and tax is 1 million, 1 million. B has a debt of 2 million, 2 million. We take 5% of the 2 million is 100, while B does not have. When we take earnings before interest and tax minus interest, we get earnings before interest and taxes. This is 900, this is 1 million. We are told that the corporate tax rate is 30%. 30% of 900 is 270. 30% of 1 million is 300. This is the earnings after tax, and I want to call it it is earnings after tax or earnings to ordinary shareholders. Earnings to ordinary shareholders, like that. Like that. Earnings to ordinary shareholders for each of the two firms. Now, what we call the combined earnings is what go to the providers of capital. The providers of debt in A will get 100. Providers of equity will get that 630. Providers of equity in B will get 700, but in A they will not get anything because it doesn't have debt. What is the combined earnings? The combined earnings is earnings to debt holders in A is 100, in B is 0. Earnings to equity provider is 630 in A and 700 in B. The combined earnings in A, providers of capital in A will get more. And I want to squeeze it so that it can be clearly visible. When we look at it from this perspective, we can tell those investors in A got 730. If I could put it this way, got a total of 730, but investors in B combined, both debt providers and equity, got 700. The question that will be asked, why are the providers of capital in A that is geared getting more? The difference is explained by what we call the interest tax shield. In simple terms, we are saying that when a firm is geared, there is more for investors in presence of taxation. The difference between the total benefit to the providers of fund in two firms is 30,000, which is as a result of interest tax saving of 100,000 debt, 100,000 interest multiplied by tax rate. Interest tax saving is also known as the interest tax shield. Interest tax shield, which is equal to tax rate times in that make the providers more than the providers of capital. If there is a question on that, I can explain before I get to personal taxes. Someone is asking about the arbitrage. What I will do, I will first share these notes. You go through them because we are already gone past that. I know now you are only seeing, but you don't have the notes. You go through them, then you can ask after you have tried to read, to revise. Why are we adding earnings for debt to the earnings of shareholders? We are not adding to the earnings of shareholders. We are saying the company is financed by debt providers and the equity providers. Combined, how much are they paid? That is the argument. How much is paid to the providers of capital, whether it is debt providers whether it is equity providers, they are both providers of capital in the firm. That is the reason we are adding, because we need to see how much goes to the providers of capital. Any other question? Let's see. When now we take the issue of personal taxes, the personal tax comes in. We are saying these individuals will pay tax on personal basis. In Kenya, the personal tax is 5%. Some other countries is different. I'm not sure how much it is in Rwanda, but in Kenya it is 5%. Interest on dividend and interest, it is 5%. When they pay the personal tax, it is paid on interest and dividend. Remember, we are dealing with the corporate finance. The unit is corporate finance, and we are the topic source of finance. That is why we are concerned about what go to the providers of equity and providers of debt. The combined earnings we found here is further taxed when paid to the investors. Less personal tax. This one is 40% of 730. This one is 40% of 700. The net income here, the one for those who invested in a geared farm, they will earn 438, while those who invested in an ungeared farm, they will earn a net income of 420. This means the investors in a geared farm will earn more by 18,000. And what is this 18,000? The difference between the two farms, the difference between the net income to investors in the two farms is 18,000, which is normally given by interest tax benefit times 1 minus personal tax. We say this is interest tax benefit or interest tax shield. We multiply by 1 minus the tax rate. That is how it is explained. In case you are told to explain that by the investor, who will make more money? Is it investors in a geared farm or in an ungeared farm? When you look at the whole scenario, it concludes that borrowing is good. It is even better when there is tax. That is the whole conclusion. Borrowing is good. It is even better when there is tax. The farm is benefiting, equity holders are benefiting, all investors are benefiting out of borrowing. But it is not borrowing for consumption. It is borrowing for investment, and it is borrowing by the farms. I want to move to the very last point, where Mira and Modigliani made another argument, incorporating bankruptcy cost and agency cost, but I need to check whether there is a question. Tax for A is 292,000, not 29,200. Oh, you want to tell me I made all these errors? 292,000. That is how you prove that you are an accountant. Yes. Okay, thank you for that. Thank you for that. Anything else from the... No, the way you are following is impressing, is good. 292. Yeah, 730,000 times 40% is 292,000. That's okay. That's correct. Thank you for those who are correcting me. You can imagine preparing all this. I must have done a lot. So errors will always happen. Okay, let's continue. So that is it, and that is the argument. I want to take you to the next part. Incorporating bankruptcy cost and agency cost. We talked about the agency cost some times back. I want to demonstrate what it is in this note as I wind up for today. When Mira and Modigliani incorporated bankruptcy cost and agency cost in the year model, they argued that the value of the geared firm will start decreasing as gearing increases beyond the optimal capital structure. Now, what is bankruptcy cost? Bankruptcy costs are the end cost. Remember, you are declared bankrupt. You are declared bankrupt when your assets are less than the liability. They are the end cost incurred by the firm as a result of financial distress. What are these costs? The sale of company assets so as to improve the financial position of the company. When you are in financial distress, you will sell assets to improve the financial position of the firm. The other one is you avoid undertaking investments that could otherwise be profitable, but because of a lot of debt, you look at the risk and say that you will not undertake them. You avoid undertaking investment in profitable projects that are considered to be. The other thing is changing the company dividend policy to meet the company's financial distress needs. You stop paying dividends to make sure that there is enough money that is left to pay loans and interest. Then, if the company is finally put under receivership, the bankruptcy cost will include the management and legal expenses. That is the bankruptcy cost. This one makes the company to go down, the value to go down. The other one is the agency costs are those costs incurred by the firm as a result of conditions set by the debt holders. We call it restrictive bond covenants. In order to protect their interest in the company, they include, let me put it this way, set by the debt holders. I will put in bracket here and say that they are called restrictive bond covenants. Restrictive bond covenant. Restrictive bond covenant. In order to protect their interest in the company, they include costs such as when the debt holders realize that the firm is in financial distress, they will put conditions like no investment in particular areas which are considered risky. They will restrict you from investing in some areas that they consider risky. Number two, they will tell you don't pay dividend unless the company earnings exceed the given agreed level. They will restrict you from paying dividends. Three, they will tell you no additional debt capital. They will restrict you from borrowing. Additional debt capital should be raised by the company unless the current gearing level is reduced to a given figure. That is a restriction. It is a bond covenant that make company to incur additional cost. Now, when MM incorporated the agency and bankruptcy cost in the model, they concluded the following. This value of a geared farm is equal to value of ungeared farm plus present value interest tax shield. Remember, this is what we had said earlier, but we minus the present value of bankruptcy cost and the agency cost. This is the final formula. This is present value of bankruptcy cost and agency cost. Present value of bankruptcy cost and agency cost. That is the argument. This is all the explanation, and they concluded with this graph, this diagram. Let me show you the diagram that explains value of a geared farm without bankruptcy cost and the value of a geared farm with bankruptcy. This is the final diagram. They said, let me put it well. Let me try to squeeze this one so that it can be better. You can see it clearly. Good. This way. Value of a ungeared farm. Yeah, value of ungeared farm starts here. When you get to gearing, this is gearing. When you increase the debt, the value of the farm increases, but it will start to decrease. Value of geared farm with the bankruptcy and agency cost. The effect, the farm value would be increasing, but the effect of bankruptcy cost and agency cost make it to go down. That is what they concluded as the value of a farm in the presence of agency and bankruptcy costs. That is our end, but I will demonstrate something retro here about the debt and equity with gearing with the beta factor. Okay, let me put it this way. The effect of capital structure on the asset beta. The beta of ungeared farm, that is beta factor of ungeared farm. We say that the asset beta is the beta factor of ungeared farm. The beta factor is a measure of systematic risk, and an increase in the amount of debt in the company's capital structure will lead to an increase in the value of beta. The beta factor increases with the increase in debt. The higher the debt, the higher the beta factor. The relationship between systematic risk and financial risk is explained by the change in the beta factor. This is the beta factor for a geared farm. It is equal to the beta factor for a geared farm divided by 1 plus debt over equity subjected to 1 minus taxation. Beta factor of a geared farm is equal to the beta factor of a geared farm over 1 plus debt over equity times 1 minus tax. I will have this one explained where BEU is beta factor of equity in ungeared firm. This is what we call the asset beta. The asset beta is the beta factor of ungeared firm. BEG is the beta factor of equity in geared firm. T is tax rate, D is amount of debt, E is amount of equity. If we got that, we can determine beta factor of a geared firm. If you have this formula, beta factor for a geared firm, we can use it to get the beta factor for a geared firm as beta factor for equity for ungeared equity times 1 plus debt of our equity, you multiply by 1 minus taxation. That is the process of determining or assessing whether equity or whether the financing affects the gearing of the firm. And whether gearing affects the systematic risk or the beta factor of the firm. In conclusion, the higher the debt, the higher the beta factor. That is what we would conclude. And I think with that, unless there is a question, I have tried to explain that part of the capital structure or that part of the financing. I decided to give it along a way so that we can understand it better. Anyone with a question? Tomorrow we are concentrating on questions before we start another topic. I don't know whether there is a question. Anyone has a question? Why beta factor for ungeared firm is called asset beta while we are referring to equity? Hey, how do I respond to that one? Is the formula the same on beta factor for ungeared firm? It is just the making one the subject of the formula. So it is the same formula, but you make either beta factor of ungeared firm the subject or beta factor of the geared firm the subject. Good. If there is no any other question, I want us to stop at that for today. When we meet tomorrow, we shall deal with the other items. Have a great evening. For those who are in class, for those who are not in class and they are logged in, tell them we meet tomorrow. Enjoy your night. See you tomorrow.